How's it going? Welcome back. This is Jonathan, and in this video I wanted to talk to you about double tops, double bottoms, and those sort of patterns as they occur. Now the reason I want to talk to you is because the chart that you can see right now has somebody asking, is this a double top? So there's a few things I want to point out on this, and then we'll take a look at the actual double top that occurred and how we can potentially forecast when it would bottom, okay? So first of all, this is the Bitcoin USD chart. So I'm very sorry about always talking about Bitcoin, but this is just what's in my feed at the moment on Facebook. And he says potential double top, not saying it is, just asking. And he's got the Bitcoin USD dollar chart up and he's marked it double top. And if we go ahead and open it up, now on the grand scheme of things, this is definitely a double top, that's what it is. But if we open it up, what I noticed down here was that it's a 15-minute chart. Now, the one thing you have to look out for is that when it comes to these charts, the shorter term trend will always conform to the longer term trend. Now, obviously, you got to take that with a grain of salt because it is often the case that the shorter term trend can create the longer term trend. But unless the longer term trend is done and dusted, the shorter term trend will always conform to the longer term trend. So when you're looking at the 15-minute chart, you got to then look at the 1 hour chart, and then the 4 hour chart, and then the daily, the weekly, the monthly, and then get an idea on what is the actual trend. You see, if the 15-minute chart is pointing up and the 1 hour chart is still like heavily down, and then the 4 hours heavily down, well, the bias is still that the market is likely to move down over up. So let's take a look. So double top, good. 15-minute chart. I brought it up right here and I can see this is the section he was looking at right here where he had it drawn in and he had double top, and then I believe around here was where it stopped. So we sort of get this first sell-off and then the rollover. Okay, so the first sell-off and then the rollover. So the dude's correct in the fact that it was a double top, okay? So let me go ahead and just delete these ones right here. So we have our double top, and now you're probably wondering, well, what's going on? Now, if you're looking at the 15-minute time frame, if we take this top of this range here, and we move down, this actual price action looks very dramatic, but on a percentage base, it's only 4%. So if you were to buy a Bitcoin or look to sell a Bitcoin, I should say, in the shorty market, and you had like a leverage of just 1, you're looking at making 4%. So these shorter term time frames only work if you're going to leverage 20, 30, 50, 100 times the underlying asset that you've bought. So I wouldn't be too worried. So that's the first mistake there, is actually looking at the shorter term time frame. So let's go out and go to the 1 day time frame, for example, and the double top would be now more important if we look at a longer term, put that one back, longer term time frame, which is this one and this one, okay? So I'll get rid of those two. Let's go back into the 15-minute chart, because now I'm just going to show you quickly how you can forecast where potential lows in the markets are so that you can look to buy the market, okay? So it's very simple. And once you learn this, you'll never look back, okay? So to forecast a double top or even a double bottom, if you want to reverse these rules, to forecast where they're going to potentially stop moving, you take the range. Now I talk about the range all the time, and not many people do, but the range is simple. It's the top and then the bottom of that move. So you have your M shape, so that's the M shape. So you have your top and then you got the bottom of that move and you have your M shape, and you want to know what the difference is between the top and the bottom of that M shape, okay? And that's going to give you the range. So in this case, we got around 50,300. And then down here, we've got around 49,000. So you'd take that and you'd get your range. And then what you'd do is you'd flip your range down between 100 and 200%. So that's the average that these markets decline in a bearish momentum if it's a double top, and it's the average that the market will rally in a bullish momentum if it's a double bottom. So you take this range, let's say we do it like this. You take that range and then you bring it down. So that's the first range, that's 100%. and then you have your second range, which will give you the 200%, okay? So I'm going to do this automatically because there's some tools that we can use, and that's the Fibonacci price extensions. I'm just going to measure this range here. Actually, let's bring it down to the first low. And then what we can see is you got our 38, 50% ranges, which are automatically in there. And then I've added on the 100% range, so that's 100%. And then the 200% range. So it's taking that range and taking it a further flip of up to 200%. So if we look at the first one and we just analyze price market action, this is the 100% range. So that's where this has repeated down one full step. And then this one here is where the market has repeated not one step, but another step, okay? So out here, if we were looking to buy the market, we would have been watching any price action that was going to occur around here to see what was going to happen. Now, if the market came down and then rebounded, that would have given us a good clue that the market is likely to advance from here. But what we got in this instance is that instead of advancing, the market actually shot through it on a 15-minute time frame, and that means we would automatically looking forward to our next range, okay? And that was the 200% level. So if we go out and we're looking for anything around this point in time, remember we always give it, I like to give it a percent, but I don't know if this was a percent, so it's actually 0.09%. So it's pretty much an identical hit we have, and we're obviously working with big numbers here, but I like to give anything regarding price between 1 to 2%, okay? Now when we're looking at a 15-minute time frame, we might want to like bring those shorter time frames down by a factor of 10. So then you'd be looking for 0.1% in that instance, and then even out to 0.2%. So the average, I would say in this instance, that you'd want to be comfortable with is 0.2%. And what we had here from our low, if I move up, we have, if I'm trying to get the most accurate answer, around 0.11%, okay? So that's considered a hit. And then what happened from this point on is the market hit the bottom, we got our strong close, we had a bit of a falling doji there, then we had a strong close, and now we are leveling out to find out what happens next. So that is how you forecast tops and bottoms using double tops and double bottoms. And instead of asking the question, is this a double top or is this a double bottom, like this gentleman has, just go in and do the next form of analysis, which is the forecasting. Because then that, instead of questioning, is it a double bottom or is it a double top, you're going to know what is the price action likely look like, and if it is going to go down, where could it stop? Anyway, I hope if this is the first time that this is going to be an introduction to double bottoms and double tops for you, I hope that this served you well and you learnt at least a thing or two. And if you did, let me know in the comments. If not, well, that's okay. We're not all going to be learning something every day. But if you want to stick around and learn more of these simple tips and tricks that can help you become a better investor, hit the subscribe button and I'll talk to you soon.